Meanwhile, in the labor market, we're seeing an uptick in jobless claims from the previous week. The number of Americans applying for unemployment benefits rising by 13,000 in stark contrast to that Friday jobs number. For more on this, we turn to Callie Cox, eToro USA investment analyst. Nice to see you. So let's just start, big picture and how you would characterize the economy at the moment. Jamie Dimon with Reuters said it's really strong right now. And what's been your prevailing lesson through earnings thus far?
Well, I certainly wouldn't take Jamie Dimon's side because he did say it was like a hurricane a few months ago. But I, in a way, I do agree with him. I think the economy is proving more resilient than we think. And there are a lot of signs around us that point to that. I mean, the jobs number that we saw on Friday and the earnings season where earnings once again are coming in better than feared. That's not to say that we're not in this slowdown of sorts. I think it's clear that we are, but we're not quite in that recessionary period just yet, even though there could be some mini recessions rolling through the economy.
Well, and Callie, a big question mark in all of this is the consumer, the strength of the consumer right now. We're starting to see some of that spending cool a bit. How worrisome is that for you?
So I won't be too worried about the consumer until I see the job market crumble, because the job market is the engine of the economy, and it's the primary reason why Americans feel so good about spending right now. I think you are seeing spending slow down in certain sectors for sure. We have seen that goods to services rotation, and now we're seeing, services bring in some iffy activity numbers. But overall, the consumer still looks quite strong, especially considering the hammer that the Fed has taken to the job market and the bluff that the job market has pushed back on that.
Yeah, and how do you think the Fed, and though Jerome Powell was asked about this multiple times the other day, how do you think the Fed actually did see that Friday jobs report and these couple of earnings that we've seen the last few days where the consumer is continuing to spend?
Well, the Fed is in a tricky place right now, and I want to be clear. A strong job market is a good scenario. It's kind of tricky in the context of an unbalanced economy, but it is a good thing that people have jobs and they're making a living wage and those wages are growing. The Fed season is tricky because the Fed is trying to get demand side inflation down, that's services inflation, and that's more driven by the job market. It's more driven by the fact that we're making a higher paycheck. So the Fed probably, after those job numbers, probably sees more of an argument to keep rates higher for longer. We already knew that was happening, but the market is realizing even more so that the Fed has a case to do it.
So, Callie, in that environment, so far to the start of the year, we certainly have seen a rally. The Nasdaq's up about 12% since January 1st. Can this rally continue given this high rate environment? Yeah,
so I suspect that we've seen this growth-fueled rally because we've seen such a precipitous drop in long-term yields, which could be a bad story. Typically, people pile into bonds when they're worried about growth. But on the short side of things, short-term rates really haven't budged, and the Fed has given us no inclination that it expects to cut rates anytime soon. So we're getting a little cautious around where this rally is now, especially because it's been fueled by these growth and speculative stocks. We're reminding customers that it is a high-rate environment, and because it's a high-rate environment, people are going to be looking toward what's working now versus what could work later. Just to proceed with caution here because the air is thin.
And Callie, zeroing in here on inflation, that rate that we're seeing today, lots of talk about getting it back to 5%, that's not too far from where it is today, but then getting it all the way back to that 2% level that the Fed wants. Is that realistic?
That's going to be tricky in our view because, again, they're looking at demand side inflation. They're looking at the services inflation, the kind of inflation that's fueled by a strong job market and wages. And again, it's good that we have a strong job market, but it makes the Fed's job a little bit harder because the Fed needs to get that demand down a little bit more. Thankfully, it's moving in the right direction now, which keeps us optimistic. But there is a bit of a worry that that services inflation could stop at an elevated level, and that could keep inflation around 3, 4, 5%. Historically low, but also quite higher than where the Fed wants it to be.
And you say you're talking to clients about what's working now and against what's going to work later. Given the setup you just laid out, what do you see working later?
So when I say working later, I'm talking about companies that are relying on either concepts or companies that are being invested in because people are optimistic they could earn profits down the road. And talk about the inverse of it too. What's working now? We're thinking about financial strength. We're thinking about quality. Those companies that are generating cash flows and are generating profits in an environment like this. And it's not wrong to invest in more speculative stocks, but we're just being careful about reminding people that, you know, in an environment like this, those smaller, more speculative companies struggle to get that investment, struggle to pick up that capital. So it could be a more riskier endeavor than you think.
Indeed, a tough environment for capital. Callie Cox, eToro USA. Nice to see you. Thanks.